Something unusual is happening beneath the surface of the financial markets. Gold and silver may not simply be reacting to another market move. They may be responding to something far more important, a growing need to protect the financial system itself. Because when governments begin supporting markets that are struggling under the weight of debt, the immediate question is not whether the rescue works. The real question is who ultimately pays for it. And if the answer is the currency, the consequences for gold, silver, and mining stocks could be much larger than most investors realize. But there is one signal hidden inside the bond market that could reveal just how serious the situation has become. And what that signal means for precious metals may be the biggest surprise of all. Welcome to Next Alert. For everyone joining this channel for the first time, the goal here is simple: to understand what is really happening behind the headlines and what it could mean for markets, wealth, and the economy. If you value calm, serious analysis rather than market noise, consider subscribing to Next Alert. And before continuing, let the channel know one thing. Where in the world are you watching from today? Because the story unfolding in gold and silver may reach far beyond Wall Street. And the next move could already be forming where very few investors are looking. Gold and silver sense, a rescue. What you need to know about metals and miners now. The most important story in precious metals may not be the latest move in gold or silver itself. It may be what those prices are beginning to reveal about the financial system underneath them. When gold rises, investors often assume the explanation is straightforward. Inflation is increasing, interest rates are falling, geopolitical tensions are worsening, the dollar is weakening, but sometimes the market is responding to something deeper. A growing belief that policymakers may eventually have to intervene to prevent stress in one part of the financial system from spreading into another. That distinction matters. A financial rescue does not always arrive with an emergency announcement or a dramatic headline. Sometimes it appears through liquidity measures, changes in government borrowing, support for financial markets, or policies designed to prevent bond prices from falling too quickly. The action can look technical on the surface while carrying a much larger message underneath. And that message is particularly important for gold and silver. The modern financial system depends heavily on confidence. Governments depend on investors to purchase their debt. Banks depend on functioning bond markets. Businesses depend on predictable financing costs. Central banks depend on financial stability when setting monetary policy. When one of these foundations begins to weaken, policymakers face a difficult choice: allow the market to adjust naturally, even if that adjustment creates severe financial pressure, or step in and stabilize the system. The second option can prevent immediate damage, but it creates another question: what happens when intervention becomes increasingly necessary? This is where precious metals become interesting. Gold does not depend on the promise of a government to make an interest payment. Silver does not require a central bank to maintain its value. Neither metal can be created through a policy meeting or expanded with a keystroke. Their supply is constrained by physical production, and their historical role becomes more important when confidence in financial assets begins to weaken. That does not mean every intervention automatically sends gold and silver higher. Markets can move in the opposite direction for weeks or even months. Rising real yields, stronger currencies, tighter monetary policy, or investor profit-taking can create significant corrections. But the larger monetary structure can remain supportive even while prices fluctuate. This is why the current environment deserves more attention than a simple question of whether gold is up or down on a particular day. The deeper issue is the relationship between government debt, the bond market, interest rates, and the currency. If borrowing costs rise substantially, governments face higher debt servicing expenses. If policymakers attempt to contain those costs through intervention, liquidity can enter the system. If that liquidity eventually contributes to currency depreciation or renewed inflationary pressure, investors may look for assets that can preserve purchasing power outside the traditional financial system. Gold is usually the first destination. Silver can follow with greater volatility and, under the right conditions, greater upside. But there's another layer to this story that could be even more important. The real warning signal may not be found in the gold chart at all. It may be found in the market that has historically been considered one of the safest places in the world, the US Treasury market. If that market increasingly requires support, the implications extend far beyond bonds. They reach into currencies, inflation, interest rates, central bank reserves, and ultimately the valuation of gold, silver, and the companies that produce them. And that is where the rescue story becomes much more complicated. There's a market that rarely dominates conversations about gold and silver, yet it may hold the key to understanding both: the US Treasury market. For decades, government bonds have occupied a special position in the global financial system. They have been treated as liquid, relatively safe assets that could absorb enormous amounts of capital during periods of uncertainty. Investors bought them for income. Banks held them as high-quality assets. Foreign governments accumulated them as reserves. That structure created an important assumption. When financial markets became frightened, money would eventually move toward U.S. Treasuries and the U.S. dollar. But what happens when that assumption begins to weaken? The answer changes the entire precious metals equation. The problem begins with debt. A government that continually borrows must continually refinance existing obligations while issuing new debt to finance spending. As the amount of outstanding debt grows, the sensitivity to interest rates becomes greater. A small change in borrowing costs may have little significance for a government carrying manageable debt. A much larger debt burden is different. Higher yields can eventually translate into substantially higher interest expenses. That creates pressure on future budgets and makes the bond market increasingly important to economic stability. This produces a difficult policy dilemma. If policymakers allow bond yields to rise freely, the market may restore balance through higher borrowing costs. But those higher costs can place pressure on governments, businesses, banks, housing, and financial markets. If policymakers instead attempt to stabilize the bond market, the immediate pressure can be reduced. But stabilization comes with its own consequences. When authorities create additional demand for government debt, provide liquidity, or otherwise encourage investors to remain in the market, they can prevent a disorderly adjustment. Yet they may also be postponing the underlying problem rather than eliminating it. That distinction is critical. A rescue can buy time. It does not necessarily remove the debt. And markets eventually begin asking a dangerous question. If private investors are becoming less willing to absorb government debt at existing prices, who will become the buyer of last resort? That question connects directly to gold. Because gold becomes more attractive when investors begin questioning not only individual companies or currencies, but the stability of the financial architecture itself. There is another complication. Foreign central banks are not passive participants in this system. When countries need to manage their currencies, they may adjust their holdings of dollar assets. A decision involving Treasury securities can therefore become connected to currency markets, international reserves, and monetary policy abroad. One country's attempt to defend its currency can influence another country's bond market. A change in bond demand can influence yields. Yields can influence government financing costs. Financing costs can influence policy decisions. And policy decisions can influence the value investors place on gold and silver. This is how a seemingly technical bond market development can eventually become a precious metal story. The important point is that gold does not need the financial system to collapse for its investment case to strengthen. It only needs investors to believe that the system requires progressively greater intervention to remain stable. That is a much lower threshold, and it creates an unusual situation for investors. A policy response that succeeds in calming markets may temporarily reduce demand for safe haven assets. Yet the same response can reinforce the longer-term argument for monetary hedges if investors conclude that stability increasingly depends on intervention. This is why the bond market deserves attention before the next major move in gold and silver. The question is no longer simply whether Treasury yields rise or fall. The more revealing question is why they are moving, who is buying the debt, and what policymakers are willing to do if demand weakens. Because if the answer increasingly points toward intervention, the market may be approaching a new phase, one in which the rescue itself becomes the signal. The most dangerous phase of a financial rescue is not always the moment the intervention begins. It can be the moment markets realize why the intervention was necessary in the first place. That is where the US dollar enters the story. For years, the dollar has benefited from a powerful advantage. It sits at the center of global trade, financial markets, and international reserves. When uncertainty rises, investors have often treated the dollar as a destination rather than a source of risk, but that relationship is not guaranteed forever. When governments respond to financial pressure with additional liquidity, easier financial conditions, or measures designed to support debt markets, investors begin evaluating something beyond the immediate effect. They start asking what those policies could mean for purchasing power. This is where gold becomes particularly important. Gold does not need to outperform every asset every month. Its role becomes more significant when investors begin questioning whether cash and government debt will preserve purchasing power over a longer period. That distinction separates a temporary market trade from a structural monetary trend. A stronger dollar can pressure gold. Higher real yields can create another headwind. Expectations of tighter monetary policy can cause investors to reduce exposure to precious metals. Yet those forces can change quickly when the underlying economic conditions change. Suppose policymakers face a choice between allowing borrowing costs to rise sharply or introducing measures that reduce financial stress. If the second path becomes increasingly attractive, markets may begin pricing in a different future. More liquidity, more debt refinancing, more pressure to maintain financial stability, and potentially more pressure on the currency. This does not mean that every increase in liquidity immediately produces runaway inflation. The transmission mechanism is far more complicated. Money can remain within the financial system for extended periods before affecting consumer prices or asset valuations. That is why investors need to distinguish between liquidity entering the system and inflation appearing immediately in the economy. The two are related, but they are not identical. The same principle applies to interest rates. A Federal Reserve that appears determined to keep rates restrictive can temporarily challenge precious metals. But if financial conditions deteriorate enough to force a change in policy, expectations can reverse rapidly. Gold often responds not only to where rates are today, but to where investors believe real rates, liquidity, and monetary policy are heading next. Silver adds another dimension. Unlike gold, silver has substantial industrial demand. That means its performance can be influenced by economic growth, manufacturing activity, technology demand, and commodity cycles in addition to monetary conditions. This creates a fascinating setup. If economic growth remains resilient while monetary concerns intensify, silver can benefit from both sides of the equation. If economic growth weakens sharply, however, silver can experience greater volatility than gold. That is why the two metals should not simply be treated as interchangeable safe havens. Their similarities matter. Their differences matter even more. The next major move could therefore depend on which force dominates: stronger financial conditions and a resilient dollar, or growing concerns about debt, liquidity, inflation, and the sustainability of the bond market. Several outcomes remain possible. A controlled stabilization could keep gold volatile but supported. A renewed inflation problem could strengthen the monetary case for both metals. A major bond market disruption could accelerate safe haven demand, and a broader stock market correction could initially pressure mining shares before creating a powerful rotation toward precious metals. The key is that none of these scenarios requires an immediate collapse. Markets can change direction long before a crisis becomes obvious to the public. That is why the dollar may be one of the most important charts to watch alongside gold and silver. If the currency begins losing importance at technical levels, while policymakers are simultaneously increasing efforts to stabilize financial markets, the message becomes harder to ignore. And if that combination continues, the story may move beyond physical gold and silver, because the companies producing those metals could offer something even more powerful: operating leverage to the next stage of the precious metal cycle. There is a point in every precious metal cycle when the question changes. It is no longer simply whether gold and silver can rise. It becomes a question of who benefits the most if they do. That is where mining stocks enter the picture. A mining company is not gold sitting inside a vault. It is a business. It has employees, equipment, energy costs, transportation expenses, financing requirements, political exposure, and operational risks. That makes mining shares considerably more complicated than owning physical metal. But it also creates something physical bullion cannot provide in the same way: operating leverage. When the price of gold or silver rises while production costs remain relatively stable, the additional revenue can flow disproportionately toward a miner's profit. Consider a simplified example. If a miner produces an ounce of gold at a total cost of $2,000 and gold trades at $2,500, the difference is $500. If gold rises to $3,000 while the production cost remains near $2,000, that difference becomes $1,000. The metal price has increased by 20%, but the potential margin has doubled. That is the attraction. It is also the danger. If metal prices fall while operating costs remain elevated, the same leverage works in reverse. A relatively modest decline in gold or silver can produce a much larger decline in a mining company's earnings expectations. This is why miners should never be treated as a simple replacement for physical metals. They are a leveraged expression of the metals thesis, and that distinction becomes especially important during a stock market correction. A major equity sell-off can cause mining shares to fall initially, even if gold and silver remain fundamentally strong. Investors may sell liquid positions simply to raise cash. Funds can reduce exposure across entire sectors. Mining companies can therefore experience short-term pressure precisely when the underlying monetary environment is becoming more favorable to precious metals. That apparent contradiction has occurred before. The initial reaction to a financial shock can be indiscriminate. The later reaction can be much more selective. If investors eventually move away from risk assets and search for stores of value, gold and silver can become beneficiaries. If the bond market is also under pressure, the traditional rotation into government bonds becomes less straightforward. That creates an unusual possibility. A stock market correction does not automatically invalidate the precious metals thesis. In some circumstances, it can strengthen it, but investors still need to separate quality from speculation. Large established producers generally have greater operating infrastructure and access to capital. Mid-sized producers can offer greater growth potential, but may carry additional execution risk. Exploration companies can produce extraordinary returns in rare cases, but they also carry the highest degree of uncertainty. The temptation during a metals bull market is to chase the most dramatic story. That is precisely where discipline becomes important. A business with a strong balance sheet, productive assets, manageable costs, and credible management may not generate the most spectacular headline return. But the objective of a serious investment strategy is not to identify the most exciting stock. It is to identify opportunities where the potential reward is justified by the underlying risk. That principle becomes even more important if the broader thesis is correct. If government debt continues expanding, if bond markets require greater support, if monetary policy becomes increasingly constrained, and if confidence in traditional safe havens gradually weakens, the precious metals sector could experience a much larger structural shift. Gold could remain the monetary anchor. Silver could benefit from both monetary and industrial demand, and miners could provide amplified exposure to the entire movement. But none of that means investors should assume a straight line upward. Markets rarely move that way. There will be corrections. There will be false breakouts. There will be periods when the dollar strengthens and metals retreat. There will be moments when mining shares appear to have completely lost their momentum. The important question is whether those setbacks represent a change in the fundamental thesis, or simply another stage of the cycle. For businesses and investors thinking several years ahead, that distinction matters enormously. The central story is therefore not that gold, silver, or miners are guaranteed to rise. The deeper story is that the financial system may be entering an environment where maintaining stability requires increasingly sophisticated intervention, and every intervention has consequences. If the rescue succeeds, it can buy time. If the rescue requires increasing liquidity, it can influence currencies and inflation expectations. If confidence in bonds weakens, gold can become more important. If gold rises strongly, silver and miners can potentially provide additional leverage. That is the chain connecting the entire story. The real opportunity may not be hiding in one particular chart. It may be emerging from the interaction between debt, bonds, currencies, liquidity, and real assets. And that is why the most important question for the years ahead is not whether the financial system will be rescued again. It is what the next rescue will cost.